Hi everybody, thank you very much for joining us for this presentation on property versus investments. I'd like to give you a few seconds just to read a disclaimer before the session itself gets started. I hope you enjoy this presentation and you find it really useful. Thank you. Hi everybody, my name is Abraham Ace. I'm a Chartered Financial Planner with Atticus Financial Planning. Thanks very much for joining us for today's session on property versus investments. It's a question I get asked about quite a lot. People come up to me and say, "Hi Abraham, I've come into some money and I don't know which I should do. Should I buy a second property or should I invest in a portfolio of investments? Which is best?" And in the UK, the reality is that most people feel really quite comfortable with property as a way of growing their money because firstly, we all live in property. We feel like we understand it. It's quite substantial. It's tangible. You can go up and you can go touch it. We feel like we know where the growth and the returns come from. And I understand that. And my standard answer to people when they come to me and they ask me which is best is actually, it's not an either-or situation. In reality, if you've got the choice and the ability to do so, I'd say buy a little bit of both. See if you can buy some property and buy an investment portfolio. And the reason for this is because as a financial advisor, I'm always trying to encourage my clients to actually spread their investment risk. And these are two different asset classes, and by buying some of both, you're spreading your investment risk and you're reducing the volatility on your overall portfolio and the level of risk on your overall portfolio. So, unfortunately, a lot of people aren't that happy with my standard answer. And quite often that's because they don't have enough money to buy both. And they'll say, "Come on, Abraham, get off the fence. I need to make a choice. Can you tell me which is best?" And just as once, what I'll do is I'll actually step off the fence, I'll get off the fence and I'll make a decision. And from my perspective, I favour investment over property. I own both, I have a property, I have investments, and I do favour investments over property. And for the rest of the session, what I'll do is I'll look at different areas, look at a couple of comparisons, and hopefully explain why I feel that way. So what we'll do is we'll look at performance, we'll look at the yield of the different asset classes, we'll also look at the tax treatment of the different asset classes, we'll look at the liquidity, the cost for setting up these kinds of holdings, the risks that are involved with each asset class, and also how easy is it to carry out things like estate planning and inheritance tax mitigation with each asset class. Right, but the first thing I need to clarify is what do I mean by property and what do I mean by investments. So in this case, when I'm talking about property, I'm talking about buy-to-let property, where somebody goes out, they pay a 25% deposit, take out a mortgage, and then they rent the property out using the rental to pay their mortgage, with the intention of building up a portfolio of residential properties, which they eventually will have paid off and can use the rental income to generate an income that can be used to meet their living expenses. All right. With investments, I'm talking pretty much about pretty vanilla investments. So shares, corporate bonds, government gilts, commercial property funds, investment funds, investment trusts, open-ended investment companies, things that we probably call mutual funds generically, or unit trusts. So pretty bog standard things. If you've got a pension, you probably hold funds within your pension spread across different shares and corporate bonds, etc. So that's what I mean by investments. And what we're going to do is we're going to compare the performance of all of these, property versus investments in this context. All right, so if we start out firstly by looking at performance. All right, so what I've done is I've looked at a period of 28 years till now, and I've compared the performance of the nationwide property index with the FTSE 250 and the FTSE 100. The FTSE 250 is the next 250 biggest companies in terms of market capitalization after the FTSE 100. The FTSE 100 being the 100 biggest companies in the UK in terms of market capitalization. All right, and so we've gone back 28 years. And over 28 years, the Nationwide Property Index seems to indicate that you would have seen 361% return on your money over that period of time. Now that is a UK average, and there will be regional differences. So you would have seen more return in London, for example, than you would have seen in the north of England or in Scotland. Similarly, if we look at the FTSE 250 over a 28-year period, you would have seen a 797% return, which substantially outperforms property. But it's a bit of a strange comparison because the reality is that most people aren't going to just hold the FTSE 250 index. If we look at the FTSE 100, just to provide a bit of balance, then over 28 years you would have seen a 173% return. But once again, it's a bit of a strange comparison because you really, these days in particular, you wouldn't just be holding a FTSE 100 tracker as your sole investment fund. But it just gives you a comparison of the performance. And what I'm trying to highlight here is when people sort of go, oh, property's just, you know, sort of absolutely slaughtered the markets over the last however many years. Well, that's not strictly true. And we can see that. If you had held the FTSE 250, you would have seen almost a double return. You would have seen almost twice as much return as you would have seen from the property on average. Okay, what I would say really in property's favour is if you look at the graphs, and I've got a far more in-depth article on this on my website. But if you looked at the actual graphs of the return, property would have given you a far smoother ride through this whole process. Whereas with the FTSE 250 and the FTSE 100, you would have seen far more volatility. So that's something, a big tick in property's favour. But when we look at these kinds of investments, we're not just focused on the growth in the value of the underlying asset. We want to see some sort of income yield. And with property, that's rental income. With investments, it's dividends and income returns. All right, so we're just going to call that generically the yield. And if we look at property first, what is the average rental yield? So Seven Capital says that the average rental yield in the UK is 3.53%. Once again, that is going to be different depending on where you are in the UK, so there will be regional disparities. And one of the funny things about this is that actually, counterintuitively, in London, property yields are lower because the property prices are higher. Whereas if you go up north to the north of England, to Scotland, property yields are higher because property values are lower. Right, now, then as a comparison in terms of return, what I've done is I've used the FTSE 100. So you can go out, you can get funds which are focused on generating a high income yield. And with the FTSE 100, that's the 100 biggest companies in the UK in terms of market capitalization. Bigger companies are more likely to pay out a dividend as a general rule. So I've used the FTSE 100 just to provide a means of comparison. So the FTSE 100, the average yield since 2000 would have been 3.48%. So as you can see, there's not a huge difference between property and the FTSE 100. But argument for property is, once again, the return from property, the yield from property is far more stable. Whereas with the yield from the FTSE 100, which is made up of companies, the yield is dividends, and dividends are a share of the company's profits. So if the company's profits are high, then your dividend yield should be high. If the company's profits are low, then your dividend yield is going to be low. So over that period of time since 2000, you can see a lot of volatility in the yield from the FTSE 100. But in terms of flexibility, you can do something with investments that you can't do with property. So with property, effectively all you've got to generate income is the rental yield. That's all you get every single year. The only way you can realize the equity in the underlying property is by selling the underlying property. You can't just sell a portion of your underlying property, so you can't take a few bricks out of the underlying property and go sell those to release some of the equity. It's a bit of an all or nothing sort of situation. Whereas with shares and with investments, you have the option to utilize a total return basis to draw your money out. So what you can do then is you receive your natural income, which is your dividends and income yield from the investments. And then what you can also do is you can sell down some of your units or some of your shares to release some of the equity within the portfolio to make up any shortfall that might be there, which might exist in terms of the natural yield and what it's paying out. And we call that the total return basis, because you're drawing out both the dividends and underlying capital gains. And provided all you're doing is taking out the underlying growth, then you shouldn't see the value of your portfolio erode either. So there's a lot of flexibility there, and it can be quite useful, particularly when trying to make things as tax efficient as possible. Which brings us nicely on, a nice little segue into taxation of the different asset classes. So first thing we're going to do then is we're going to look at income tax. Okay, so first thing is that rental income is taxed subject to income tax, and it is taxed at your marginal rate, so 20%, 40% or 45%, depending on whether you're a basic rate taxpayer, a higher rate taxpayer, or an additional rate taxpayer. Now, actually, it used to be really tax efficient to buy a property using a mortgage, buy an investment property using a mortgage, because what you could do is you could offset the interest on the mortgage against the tax you're paying on your rental income. But the government's now changed that, and now instead what you get is just a tax credit, which is 20% of the mortgage interest, which is far less tax efficient, and particularly if you're a higher rate taxpayer or an additional rate taxpayer, it's far less beneficial. So when we look at investments, now as a general rule, generally investments tend, particularly shares and a lot of the funds out there, tend to generate dividends, and dividends are taxed at 7.5%, 32.5% and 38.1%. So there's a lower tax rate on dividends than there is on the rental income, which is a starting point. The other point to highlight here is that investments can be held within tax efficient wrappers. So investments can be held in an ISA, whereas residential property can't be held in an ISA. And the benefit of an ISA is that any growth and any income that you receive while the money is invested in the ISA is tax-free, and any withdrawals you make from the ISA is tax-free. Similarly, investments can be held within a pension. And with a pension, when you make contributions to the pension, you get tax relief. And so that can be 20% or 40% or 45%, depending on what your tax position is. On top of that, any investment made into the pension grows in a tax-free environment. So you've got this money growing in a tax-free environment, so you're getting growth in the money you would have paid out in tax on an arising basis if it had been held elsewhere. So you get that benefit, and then you can take 25% of your pension tax-free. So once again, there's a lot of tax benefits there. And then if we move on to the slightly less tax efficient offshore bond, so any money put into an offshore bond grows in a tax-free environment, well, largely tax-free anyway. So you get the benefit of gross roll-up, as I said, where you're getting returns on money you would have normally paid out in tax otherwise. And then in addition to that, you can actually draw out up to 5% of your original investment every single year, and HMRC treats that as a return of capital. So you don't have to pay tax on that withdrawal, and you don't even have to declare it on a tax return. So there's a lot of tax efficiency there. There's a lot of other things you can do with an offshore bond potentially, and this session isn't broad enough to cover that. But just the key thing I'm trying to highlight here is that you can hold investments in all of these tax wrappers. You cannot hold property, residential property, in these tax wrappers. So you can't benefit from that tax efficiency. All right. Once again, if we look at taxation, if we look at both property and investments, as a general rule, any gains in the underlying value of the asset are tax subject to capital gains tax when eventually you sell the investment. And so they're both subject to the same tax, and everybody gets a personal capital gains tax allowance of £12,300, so you can actually utilise that capital gains tax allowance against the gain to offset some of the gain, so that you actually reduce your capital gains tax charge, which is really useful. But the fundamental problem here is that with property you only get to use that capital gains tax allowance once in the year that you sell the property. Okay, and that's really not that beneficial. You know, it's still beneficial, you get to offset some of your capital gain, but it's not that beneficial because in all those years you haven't sold the property, you've lost this capital gains tax allowance. That's £12,300 of gain, tax-free gains, out the window every single year. All right, now, how are investments any different, you may ask? Well, the thing is this, is that if you get gains in your investment portfolio, what you can do each year is sell down some of your investment portfolio, crystallize that gain, and offset it against your available capital gains tax allowance. So against the 12,300. So you utilize it and you wash that gain through your capital gains tax allowance. And then all you do is you rebuy the investment after that. So you've realized the gain and then you rebalance your portfolio by reinvesting. Okay, it can be quite complicated, and if you've got any questions about that, just feel free to give us a call, because we're always happy to help. But as you can see, over time, that can be particularly tax beneficial. All right, now let's look at liquidity. Now, if you've sold the property, I've sold the property, one thing I can tell you now is it's hard work, and it's a long process as a general. It can take 6 months to a year to sell a property, depending on what the market is like. There's all sorts of things that can happen. You can be messed around by prospective buyers. You have people traipsing through your house because you've got to have all these house viewings. It's really quite disruptive. You have to get a estate agent involved, and that's costly. And as I said, it can be a serious disruption to your life for a long period of time. And you know, if the markets are poor, you could end up not selling your property for a year quite easily. Now, how is that different from investments? Well, with the majority of investments out there, if you're managing the investments yourself, it's the press of a button. You go onto the platform where you hold the investments, you press a button, and 4 to 7 working days later, you've got your money. If you're working through a financial advisor, once again, it's just a case of sending them a letter or giving them a phone call and saying, I'd like to sell down my investments, and they arrange that. Even for your more complex investments, so like an offshore bond, there's some investments out there that are going to take a bit longer to sell down. The process is really simple. You give your order and the order is processed. There's no really big issue around finding a buyer, etc. Then basically the assets are sold down, and because of the asset being slightly more complicated, it takes 3 to 4 weeks for the money to be paid out to you in worst case scenarios. But the key thing here is that's still substantially better than 6 months, and the cost of selling is substantially less. Generally, it's just the sales costs themselves. It's you're not paying anyone or doing a payaway to anybody to sell down your investments. So actually, it's faster and it's more cost effective to sell down. So from a liquidity perspective, the selling investments is far easier than actually selling a property. Now, if we look at costs, if we just move on to the actual costs that are involved. Now, if we look at setting up a property, buying a second property, one of the key things there is stamp duty, land tax can be quite high, and if it's second property, you've got that 3% additional charge now for people buying a second property. You have to take on a solicitor. You have to pay for a survey. There's ongoing costs, and with the ongoing costs, quite often, as your portfolio gets bigger, or as you get older, and it's more difficult to look after and manage those properties, you have to take on an agent, and agency fees for managing property can be between 10% and 20% of the income each year, which is substantial. You're paying for insurance, you're paying for maintenance, you're paying for all sorts of certificates, safety certificates. So actually the setup costs can be quite substantial, and the ongoing costs can be quite substantial. And one of the costs that we don't really take into consideration is the actual personal cost. Because when you're a landlord, you're responsible, and you're quite often the first port of call. And that might be easy enough if you're not fully employed, or you're retired, and this is the only responsibility you have. But even if you're retired, as you get older, it becomes harder and harder. And if you're on holiday or something like that, and somebody needs something done in the property, you have to get on it. And I've met a lot of clients who have built up property portfolios who really regret doing it, just in terms of the personal cost to themselves, and always being on call. So that's something to bear in mind. Now, there are costs involved with setting up investments as well, and once again, if you're not careful, you can end up paying too much. I'm not disputing that for a second. But with investments, as a general rule, you've got an initial advice fee, which you pay if you're going through a financial advisor, your initial advice fee, and an initial cost to actually set up the investment, and the cost of actually investing the money. Now, the reality is, if you're going through a financial advisor or a platform, there aren't really any setup costs on the fund themselves these days anymore. There are certain more complex funds where the investment process is more complicated, where there is an initial charge from the fund itself, but actually those are very few and far between, and if you're using a financial advisor, they'll highlight that to you anyway, and you can decide whether it's worth that initial cost. But then also in terms of ongoing fees, then there's an annual management charge on the actual fund itself for the running of the fund and the management of the investments, and you might have an ongoing charge that you pay to your financial advisor for managing your investments as well. And that charge can be anywhere from 0.5% of the assets being managed all the way through to 1.25% of the assets being managed. But really, it depends on the service you're looking for and the financial advisor that you're using for that charge. But I think actually, if we look at it all in all, the costs of buying and setting up a property portfolio and maintaining it is more, as a general rule, than an investment portfolio. Now, if we look at the risks, one of the key risks which affect both of these is that you actually get back less than you originally invested. So with a property, it can be going into negative equity, or the area where you bought the property falls out of favor, or property markets fall as a result of some or other market condition. And it's exactly the same with investments. The major risk there is a fall in the value of the markets, and you having to sell that investment when for less than you originally bought it. And for all of these, in terms of dealing with this risk, the way we get rid of this risk is we diversify. We spread the risk across a load of different regions and a load of different industries, and so for investments we spread across different regions and industries and asset classes, and corporate bonds versus shares. There's all sorts of ways we spread it across different asset classes, There's all sorts of ways of diversifying the portfolio to reduce that risk. With property, what we do is, as a general rule, you buy in different areas, different types of property, some flats, some freehold properties. You diversify across a number of different towns and regions, etc. So as one region is overperforming, the other region might be underperforming, and it balances out the impact on your performance. And so we can diversify in both situations. But here's the thing. With an investment, to diversify across an investment, I can take £25 and invest it into a fund and have my £25 automatically diversified across 30 to 60 different holdings, because it's a pooled investment. That's how they work. However, with property, if an average property is £200,000 or £300,000, in order to actually effectively diversify that, you're going to need hundreds of thousands of pounds to buy different properties with to spread the risk, if not millions of pounds. And that's where that becomes slightly more difficult. It's far more difficult to actually diversify a property portfolio than it is to diversify an investment portfolio. All right. So, in terms of estate planning and inheritance tax mitigation, once again, it's far more difficult to do estate planning and inheritance tax mitigation with properties. And one of the reasons for that is that, as a general rule, with one of the ways that we actually go about mitigating inheritance tax is we gift assets away. We gift away the assets that you don't really need. Now, actually, if you've been holding investments in ISAs, any gains that you actually built up within the investment is tax-free. So it's really easy just to gift those assets over to your loved ones, and it doesn't create a tax liability. However, with property, to gift the asset over to one of your, say, to one of your children, actually, that's a disposal for capital gains tax purposes, and you realize that all in one hit, and somewhere you have to go find the money to pay that capital gains tax liability. Now, one of the arguments that may be used is that actually, if we're gifting into trust, if we use the right trust, we can roll that capital gain into the trust, which is very true. However, you're restricted there as well, because a lot of the trusts that are out there restrict the amount that you can actually gift into them without triggering an automatic inheritance tax liability. And that amount is limited to your available nil rate band in any 7-year period. So that's £325,000. Now, a lot of properties that people are looking to gift away are worth more than £325,000. If you gift them into a trust and the value of the property exceeds £325,000, then actually the excess over that £325,000 nil rate band is going to give rise to an automatic inheritance tax liability. So that is a problem. And now, when we actually look at the actual probate process on death, if a person has a large property portfolio, all right, if they've got a big old property portfolio which they've built up over time, they may think, fantastic, we've left this to our kids, but it can cause real headaches during probate, because actually the property itself cannot be distributed until the inheritance tax liability has actually been paid. Now, if the estate is made up largely of properties and there isn't enough cash to actually pay that inheritance tax liability, the estate cannot be distributed. And we're left with a single situation, a situation where the only way that the inheritance tax liability can be paid is if it's actually paid by the executor. The executor goes out and borrows some money and pays the inheritance tax liability, and then when the inheritance tax liability has been paid, they can go away, they can sell down the property, and they can sell down the properties and they can pay themselves back. And quite often the only way the executor can do this is by borrowing the money, and quite often it's an expensive bridging loan or something like that to actually help them pay this. So that's difficult. Alternatively, you reach an agreement with HMRC in terms of paying the inheritance tax liability in installments and sort of gradually paying off the inheritance tax liability so the estate can be distributed. But actually that's subject to interest. So once again, it's more costly. Whereas with a lot of investments and things like that, they're quite easy to be sold down, and also what they can actually be used to pay the inheritance tax liability. So there's a lot of potential. There's far more flexibility and far more ease in terms of probate from that perspective. All right. So I mean, I've looked at a number of different areas here. So we've looked at performance. We've shown actually from a performance perspective, it's neither here nor there. If you're in the FTSE 250, you did better. If you're in the FTSE 100, you did worse. Chances are you were probably in a mixed portfolio, something like a 60-40 portfolio, where you got 60% in equity and 40% in corporate bonds. And actually, the average return on that since the 1970s has been about 5% a year. So, you know, you've done all right from that perspective as well. But I'd say from a property perspective, from a returns perspective, it's probably either or. And once again, from a yield perspective, exactly the same. There's not a huge difference in the yield depending on where you've invested. Property is far more stable. But with investments, you can take your returns on a total return basis. From a taxation perspective, I think that, and this is a key thing for me, is that investments are, if set up properly, far more tax efficient than a property portfolio, I feel. Investments are far more liquid. I think there's less cost in actually setting them up and actually maintaining them. And then from a risk perspective, I think it's easier to diversify risk on an investment portfolio. And from an estate planning perspective, I think it's far easier to carry out estate planning with investments than it is with property. So I think that highlights my thinking on this. Now, I just need to go back to my original statement. And my original statement is that actually, if you can buy both, buy both. They both have merits. They both have, you know, sort of property's been far more stable over that period. So both of these have merits. So if you can buy both, then buy both. But I hope this explains my thinking on property versus investment. It is a complex area, and it really comes down to what you're trying to achieve and what you feel comfortable with. If you've got any questions, feel free to give us a call. There'll be a slide in a couple of seconds with all our contact details. We're always happy to help. So feel free to give us a shout. Our initial consultation is free, and if you have any doubts, take advice from a professional, someone who's experienced a lot of things. It can make a real difference. Right, thank you very much for joining us, and I hope you have a fantastic day. Bye.
Thanks once again for joining us for this presentation. I hope you found it useful. If you'd like any further information, all our contact details are below. Please feel free to get in touch with us anytime. Thank you and have a great day.